Would I say there will never, ever be another financial crisis? Probably that would be going too far, but I do think we're much safer, and I hope that it will not be in our lifetimes, and I don't believe it will be.
Ladies and gentlemen, this statement has echoed through the last decade as the stock market reaches exuberated highs on the greatest expansion in U.S. history. And if you don't know who Janet Yellen is, well, you need to do your homework, ladies and gentlemen. She used to sit on the Federal Reserve Board, and she has one heck of a resume. And if you don't know the Federal Reserve, it is one of the only two important things in the entire economic cycles with the government, as basically the Federal Reserve is managing $4.48 trillion and $2 trillion in U.S. government debt. They are responsible for controlling the interest rates, which debate on basically where the entire economy goes with spending debt. So I really want you to understand that statement extremely well, because she made it right after 28. She is yet to be wrong, but in these all-time highs, I get quite fearful because every dummy in the market is throwing money left, right, and center and making money hand over fist. If you're OG from a few weeks ago, you'll know I did a monkey dartboard experiment picking random stocks from the S&P 500 to see if it could outperform my value investing strategy. And ladies and gentlemen, I can't believe this account is up $2,500, or basically 2.5% just in a couple of weeks, just from, randomly picking companies, which is crazy because that makes idiots feel smart. And I want to show you guys how even in these exuberated times, you can follow a philosophy that will, no matter what, in good and bad times, allow you to outperform the market. But I had a much easier time buying stocks from 2018 up till now with these extremely volatile moments in the S&P, because when people are fearful of the markets, as Warren Buffett says, be greedy when those are fearful, and be fearful when those are greedy, because it is just easy to buy stocks when people don't want to buy them. So I really look forward to breaking this down for you. So let's just jump right into this. Welcome back, my passive income investors alike. If you are enjoying these incredible stock market rallies, I am right here with you, as my account has personally just hit over 100,000 US, as I manage in a Canadian portfolio. Because I am from Canada, I just crossed over 132,000 CAD, which is the equivalent of 100,000 US, which is a bit of pat on my back. But honestly, I am getting cringeworthy at this market because people get dumb. The entire markets are up into this crazy level. As we head on to Yahoo Finance, we can read an article that just came out that says, don't bet on an average year for the stock market. And we're going to take a look at this video, but let's read this article. On Thursday, the S&P 500 closed at 3,205, a record high. The Dow closed at 28,376, also a record high. This brings the benchmark index's year-to-date gains to 27.7%, while the blue chips are up 21.5%. The tech-heavy NASDAQ outpaced both of its big three peers, however, logging gains north of 33% through Thursday's close. And so anyway, you slice it. 2019 has been a tremendous year for the U.S. stock market investors. Next year, Wall Street analysts expect that the good times will keep rolling, but with a little less force. Let's take a quick listen to this video. It's kind of interesting.
Miles with a look ahead at what will be making headlines on Friday.
All right, so as regular viewers know, stocks usually go up. The average historical return for the U.S. stock market is high single digits for the Dow and the S&P. The annual price return is around 7.5% on average. Dividends then add 2 percentage points to that. So it seems reasonable that Wall Street strategists would expect the market to rise by about that same amount next year. After all, it would seem to be the sensible call. But as analysts at Bespoke Investment Group highlighted this week, historical average returns are actually a pretty rare occurrence. Since 1900, Bespoke notes that the Dow has gained single digits just 21 times. The Dow has gained more than 10% and more than 20% in a single year more often. Now, of course, we're kind of quibbling here, right? The overall direction of the market matters more for broad investing decisions than whether the S&P gains 5%, 15%, or whether it falls, right? And we're also aware that year-ahead forecasts are really just what analysts see as most likely. There's always a range of outcomes and a broad distribution there. But the cautious optimism expressed by analysts next year might seem safe from a distance. It's just a little less likely to actually actually come to fruition than history might otherwise suggest. Now, turning to the calendar for Friday, on the economic data side, we'll get the third and final.
So, ladies and gentlemen, I made a prediction that we weren't going to see much market gains, and I honestly thought that we were going to continue to see extreme volatility in the markets going forward with everything that was going on. Now, things have drastically turned around, and I want to take a look and show you how you don't need to care what the market is doing. You just need to look for what we call value stocks. Now, what is a value stock? We're going to head on over into my personal stock portfolio. We're going to take a look at a couple of the accounts, and I want to show you a few examples of how I personally just been severely outperforming the market with specific, precise decisions that are technically based, because we do not make decisions off feelings. We have to understand the exact fundamentals behind each decision we make, and you only got to make a few right decisions to outpace the market, even in good and bad times. And I want to use the example that I continually talk about, and if you're new to this, it's going to be refreshing. If you're old to this, you're probably pretty tired of me talking about the three main positions I focused on this year, one of them being MO and BTI, which are tobacco stocks. Now, completely putting aside the fact that these are tobacco stocks, I just want to show you some of the reasons I bought these, which were currently up 13% on BTI, 13% just in this one account on MO, not including the 7% dividend yield I was able to attain when they were 13% cheaper, giving me a rate of return of just probably around 20% this year. Now, why are these considered value stocks? These are companies with underlying assets that have never really changed. If you go through their fundamentals, nothing has really changed. They're still making decent returns. They haven't really lost any revenues, but at the same time, if you head on over to their charting, for some reason, there's been a severe amount of negative news over the last couple of years, and the stocks have been proceeding into lower lows. And this is where we're going to experience what I call max pain. Now, the best example of max pain, in my opinion, was BTI, and I picked this one up damn near the bottom because I picked it up for right around $32 a share, right around in this range. And it's really easy to recognize max pain, because what you'll experience is a year or about a year and a half of a stock continuing slowly downturning until finally investors lose their shirts, they get kind of skittish, they freak out, and then the stock plummets, and you see these massive drops followed by a leveling out. It is in these moments of when these stocks level out is when we can start capturing incredible moments and incredible returns, because this is when people have finally pushed the stock to where it can't go any lower. We do not want to try and catch a falling knife, and the way we avoid catching a falling knife is by just waiting it out. And I have been doing this with another company of mine called GEO Group. GEO Group was a company I've been recently cost averaging into, but I have waited to buy it, and I actually waited for quite a few months, and we experienced some max pain moments as it dropped down here, where I picked up some more shares, and then I let it kept riding out, and when it kind of took a little dip down here, I continued to buy just a few more, which is allowing me to get some capital growth now on these lower purchased stocks. Now, this one I could still consider to be a falling knife, but it's kind of, hard to see when you consider it's happened in the past, and this usually is the bottom range for this stock. Now, it's hard to fully gauge and understand this, but you get a lot more comfortable buying these companies when we can take a look at their fundamentals, because those fundamentals have never changed. So this is how you kind of experience capturing these incredible rates of return, because people will tell you you're making a horrible investment decision and you should be extremely scared of buying these stocks at these prices. Obviously, finding these might not be the easiest thing in the world, but sometimes if you stick around in the community, you'll hear people chitter-chattering about these, and if you just take the time to look at their fundamentals and get to know these companies and fully understand how they function, and you'll realize that they're trading against market average returns, and if you pick a few shares up, you might experience these great rate of returns. There's companies like Chipotle that have experienced this recently when they had their food scare a year ago, and if you bought it during that food scare, ladies and gentlemen, you would have severely outperformed the market. Now, I even own shares, obviously, as I talk about. I'm up in my managed account here, and if we head on over into my RRSP account, another good value stock. Now, J&J is a company I only recently started buying, and I got it 10% ago, and that is because this company never trades on fair value discount. This is an S&P top 10, and this company is one of these companies you just need to buy when it looks like it's at its lower range. Now, this is a company that every time it dipped into the low, 120, 130 mark, it kind of just would go back up, and then there'd be more bad news. This is a company that took a $400 million hit, and it is a company Pablo Escobar wish he could own, because this is the kind of company that peddles oxycodone, medical supplies, medical machines. They deal with all kinds of different drugs that they'll obviously are prescription-based drugs, and they've been hit with a lot of different fines, but their fundamentals don't really get affected by this, because we're talking about a company that brings in, tens of billions of dollars like it's nothing, year over year. So it's a company that has been experiencing extremely volatile news that has kept the company under pressure. Mind you, it doesn't trade at much of a discount, considering, it's a fair valued company as it sits. But at the same time, when you're talking about these S&P top 10s, you're never going to get them at fair value. These are companies like your Microsoft, your Apple. They'll always trade at a fair value no matter what, just because they sit on that top 10. So if you can get these companies even at a slight discount when they take these fairly large dips in retrospect to the company, you're better off just picking them up. And when J&J took its final dip midsummer here, I couldn't help myself. And when I transfer money into my RSP account, I just had to buy it. Even though you're not getting the biggest dividend return, you need to hold these in your portfolio for those stability and sooner or later over market average return. Because these companies, when they turn around, sooner or later, they do. You just got to be patient. But you do not want to be buying these at the tops. If you were buying this at the top in 2018, you'd be experiencing, these massive dips, and you still wouldn't get much return except for the dividend. But if you take your time and you try and find these companies when they're on these dips, sure enough, look at that. We can get a 10% return just in, not even a couple months since I've been buying this, and you're also getting these really healthy dividends. This is what we call value investing. Obviously, in this portfolio, I hold Tesla for some growth, which we've been experiencing great exuberance, which I'm not going to comment on in this video. I've talked enough about Tesla. I just specifically wanted to talk about the style of investing called value investing, which always outperforms the indexes, because I hold the index to compare myself to, and I'm only up 5.8%, whereas if I just dumped the rest of this money into J&J, into, MO or BTI, I would severely outperform these basic market returns. And I'm never selling them, by the way. I plan on buying and holding these forever, because that is the Warren Buffett style of investing: buy and hold forever and collect the entire, because that's the way you value a stock, ladies and gentlemen. You have to look at it over what it's going to achieve for you over the next 30 to 50 years. This is like getting a 30% discount off a Rolls Royce, ladies and gentlemen. When this company hit its bottom, we're talking about a 50% discount. And I mean, if we go back, say 30 years, and you were buying this in the mid 1980s, your rate of return even till to date, not including those dividends, which would be absurd, is a 6,000% return, guys. And I hope you guys will stick around and consider subscribing to follow my growth and my future potential. And I'm proud to say, ladies and gentlemen, I'm able to help hopefully guide you as you also guide me. And I do make mistakes. I'm not perfect, ladies and gentlemen. I have made some mistakes, continue to make mistakes, but luckily the good decisions that I make severely outpace the mistakes. So I'd love to know everything that you guys think in that comment section below, and I will promise to reply on this video, because this is a fascinating topic in these exuberating times. So stay cool, stay awesome. I look forward to chatting to you all real soon.